Hi, everyone. Mike White here. Welcome to this week's vlog post. It's been another crazy day yesterday in the bond market. Really tough to deal with. Things were moving along, and then the wheels kind of came off the wagon after the Fed announcement. Things got to get worse as more information came out and people were processing that information. And to be honest with you, I think the markets are having a tough time dealing with the information that's coming out, the perspective of the people that are putting out that information. I've spoken repeatedly to the fact that the Fed itself has been kind of late to the party and putting out messages that most people, quite frankly, are not 100% confident in. Treasury Secretary Yellen was out there day before yesterday, and I don't know what possibly she could have been thinking, and most of the markets are trying to figure out what she was thinking when she clearly stated that the only way to eliminate inflation in this country was by massive government spending. I don't know. I really don't. But the reality of it is we've seen some crazy fluctuations in the bond market. We know inflation is real. We know, based upon the meeting yesterday, that the quantitative easing will be over in March. It's likely we're going to see Fed rate hikes starting then. And the Fed also put out a supplementary announcement that stated that they were going to start paring back the balance sheet, which really points to the fact that they're going to be eliminating their reinvestment in the mortgage-backed security arena as loans get paid off, instead of what they're doing now, which is coming into the mortgage bond market and repurchasing those securities. They're going to just pare them off the balance sheet, which means less demand in the mortgage arena means higher rates. So as we've talked about since last March, higher interest rates, really, if you like it, lock it. Don't be the riverboat gambler. Explain the differences to your clients, but use factual data. The fact that we've left the twos and through the threes and heading through the fours doesn't mean that there's nobody interested in buying houses. You just have to do the comparison to what rental rates have done. And I think far too many loan officers don't extol the virtues of locking your cost of your housing when it comes to A, the price of the house, and B, what your principal and interest payments are. Because we're seeing that rental rates in most of the country, and this is where you have to do your due diligence in your local market and compare a typical property. And I've had my loan officers doing this with a great deal of success. They're showing people, this is the difference between renting and owning. This is what the place you were renting cost last year. Here's what your rent's going up to. Here's what that house that you would have thought about buying last year cost. Here's what it costs now. Here's what the monthly payment is. Now, I get it. It would have been nice last year to buy a $250,000 house and finance it with a 30-year mortgage at 2.5%. And now you're looking at a $300,000 house for the same house because of appreciation. And you're going to have to finance that house, at 4%. And so, yes, the payment's higher. We're financing more money at a higher rate. But when you compare it to what that rental is doing, and the fact that once you buy that house and once you fix that principal and interest payment, and again, we're not talking about taxes and insurance, which are a minimal part of your payment, but something to consider. Obviously, those things do rise, but you're fixing your largest portion of that, which is your principal and interest payment and the cost of your home. And think about that as to what is happening with the rental market, because as inflation continues, and most everybody will agree inflation is going to continue, what are the price of houses go up? There's no slowing down right now in the demand for housing. And yes, while I don't think we're going to see price appreciation anywhere near 18, 19, 20% this year, even an increase of 6, 8, 10% in property values, well, then do the math, have the conversation of where you think it fits and say, look, this is the cost of waiting. If you project out just this year, where do you think inflation is going to be? Do you think inflation is going to be the same as this year, worse, whatever? Right now, we're hovering 7, 8, 9% inflation, depending upon the data you want to look at. Many consider it to be even more than that when you look at real life expenses. But the key to this is you lock in that principal and interest payment. And over time, what happens is the percentage of somebody's income toward their housing payment actually goes down. And again, in the old days, we used to use what we call the front end ratio, calculate out the front end ratio, the housing payment versus their income. And if that person is in a spot where they think their income is going up to 5, 8, 10%, whatever it is a year, and then you're looking at fixing their principal and interest payment and saying, okay, here's what my principal and interest payment is doing, and here's how it relates to my total income, you're going to see that while rents continue to rise and remain a significant part of somebody's income, somebody in a 30-year fixed rate loan, their actual housing costs go down because they're making more money and they've fixed those payments. And that is a situation that I don't think we spend enough time sharing with our people. And yes, I get it. The people who sat on the sidelines last year who said, I'm waiting for the housing prices to go down and I'm waiting for interest rates to go down, unfortunately missed the boat. That gamble didn't work for them. But is that same gamble going to work for them this year? Because many places across the country, and you can look up the facts, just Google search in your marketplace what the increase in rents have been. We're seeing across the board, and where I'm working with people, it's 15, 20, 25% or more increases in the cost of rent. And there's no benefit to rent. It's just an exchange of money for time. Whereas with a mortgage, at least you're building equity and you're paying down an obligation. So I think it's important for us to do some math and have these conversations and be really certain that we create the awareness of, yes, everybody would rather have 2.5% than 4%. Everybody'd rather have 4% than 5%. So pull up the charts, look at the numbers, pick places in time, show people where rates have been, what payments actually look like. Because without putting this information on paper, you're dealing with the pure emotion of higher prices and higher interest rates. And you can't win an emotional battle with somebody who feels disappointed that they missed the boat buying the house that they wanted at a lower price and a lower cost to finance. You got to show them how buying today and using today's market compared to what the future may hold is really beneficial, because at least they lock in those principal and interest payments and the costs of that house. So as always, if you have any questions or comments, it's Mike@imtcoaching.com. We look forward to sharing time and strategies with you next week. Take care.